Hello everyone. Assalamu alaikum. This is the start and the first episode of our series of Introduction to Financial Risk Management. So initially we planned to cover the history of financial risk management, but when I was preparing the session, I thought that it's before we go into the history of the financial risk management, it's better to go and discuss some of the basics of financial risk management, and hence this episode is more about the very basic, that is covering the basic definition of risk, expected and unexpected loss, and a couple of other things. So to start with, you must have heard of various definitions of risk, which is generally termed as the uncertainty surrounding outcomes. So whenever we talk about uncertainty, the other word that we use for uncertainty is actually volatility. And volatility, uh, by definition, means deviation from the mean. Okay, so in the quantitative analysis, we talk about the mean, or in layman terms, average of a particular series. Uh, so volatility defines of how proportion, of how intensity your observations or your outcome deviates from its average or its mean. Okay, so when we talk about the outcomes, it can vary from risk to risk, from event to event, from type to type. Okay, so for example, if we are considering credit risk, your outcome can be either default or non-default. Okay, when you're talking about operational risk, maybe we will be talking about loss, or no loss, or near miss event. Okay, so we have different categorization for the outcomes there as well. Okay, so whenever we are talking about the outcomes, obviously this outcomes, then uh, we relate the uncertainty of that particular outcomes, and that volatility and that uncertainty regarding outcome become your risk. Okay, so this is the very basic definition of risk that we cover in our FRM curriculum. This is basically from the FRM curriculum that we cover during our classes for the financial risk management certification. Then as we have understood what is the definition of risk, that is the uncertainty or the volatility uh, around the outcomes, around the possibilities. Basically, the uncertainty can either be positive or negative. Okay, so it can go good or it can go bad. Okay, so if you talk about a stock, a particular stock, let's say if we have invested in a particular, let's say we have invested in a stock called, let's say, Unilever. Okay, so if the shares of Unilever goes up, okay, then the investor wouldn't be worrying about it, and they would be happy, and they wouldn't be caring that much about the positive difference. Okay, but if it starts going on loss, okay, so if that particular stock starts booking losses one after another, okay, that's something we consider as a negative outcome, or a negative return, or a loss, or whatever you may call it. Okay, so investors are actually more concerned about the negative outcomes, and this is where risk management itself drives. Okay, so risk management basically talks about covering the losses that a particular investor can have in the invested assets. Okay, so investors are more concerned about the loss side rather than the profit side. So having said that, basically it brings me to the next topic, which is the trade-off between risk and return. So you must have heard of this quotation that is very widely known, that is very widely used, that is, the higher the risk, the higher the return. Okay, so if we talk opposite of it, it becomes the lower the risk, the lower the return. So basically the trade-off between risk and return. So whenever you are aiming higher risk, you will have to take higher, sorry, if you are aiming for higher returns, you will have to take higher risk. An example of this particular trade-off is between a stock market and the bond market. Okay, so in the bond market, you know that returns are almost guaranteed. You will get the particular coupon, you will get your your principal back by a particular date. But on contrary to this, stock market is always a bit more volatile, and that is why the returns on the bond market are actually lower than the returns that we got in the stock market. So this is a prime example of risk and return trade-off that is a relation that we call a risk reward relationship. This is primarily covered in the CFA mostly, but in the first portion of the first book of FRM Part 1, we cover it in a lot of detail. We don't only talk about it, but we also cover different factors, different models, starting from CAPM and arbitrage pricing theory and so on and so forth. Okay, here we need to understand two things: that risk is primarily the volatility, this uncertainty regarding outcomes, and then there is a trade-off between risk and return. Then let's talk about expected and unexpected loss. So I can recall distinctly that when I was giving my first interview in PwC back in 2000, I think 8 to 9, my ex-boss actually asked this question, that what is the difference between expected and unexpected loss. So I don't remember what I what I replied him, but since I got the job, I believe that I replied it right. But let's talk about it. So basically, risk management has to do more with the expected losses. Okay, so what do we mean by expected losses? So basically, we are not concerned about the size of the potential loss. The potential loss can be as high as it can be. The problem is, and the key problem that we want to solve during using the risk management techniques is whether we can identify that potential loss or not. If the potential loss is extremely high, but we are aware that that loss can happen, that we can, we can take risk management measures in and keep ourselves safe from that particular losses. Okay, so that's a good deal. But the problem exists when we don't actually know about what sort of losses we can have. Okay, so all of the risk management techniques, all of the probability default models, the value at risk models for market risk, the operation risk, RCSAs, and key risk indicators, and whatnot. All of these indicators, all of these models, all of these assumption based models talk about the calculation of expected loss. So, expected loss is anything that we can measure using the given risk management techniques. But when it becomes out of the scope of the of the calculations, of the valuations, of our estimations, then it becomes unexpected loss. For example, COVID-19 is an example of unexpected losses. So what or we can say that whatever losses we have suffered due to COVID-19 is sort of unexpected loss. Why? Because as we know that pandemic has always been covered in the operation risk framework for a very long time, but we haven't seen something similar to what is happening during COVID-19. So these are like unprecedented times. This is something that has never happened. Okay, so this is going to change the dynamics of risk management in future. That is a different debate altogether. But this is something that we did not expect. We did not cover in our risk management techniques. Most of the banks did not do it. So that becomes an unexpected loss. So expected loss is something that can be covered, that can be measured, that can be verified, that can be estimated, and that through that estimation, through that valuation, we can take measures in advance. And unexpected loss is something that could that could happen against our expectation, and that is at an unexpectedly high levels. Okay, so this is a between expected loss. Anything that you can measure is expected loss. Anything that you cannot measure is unexpected loss. So these are 3 4 prime things that I wanted to cover in this particular video. But just a brief introduction of the historical background of risk management. This is something that we'll cover later in the other episode of history also. But risk management actually officially started working in started studying after World War II. Okay, so then we have our modern risk management. I won't call it modern, but somewhat advanced risk management started between 55 and 64. So two books on risk management by Hedges and William and Hems were published in 1963 and 1964, respectively. Then the the foundation of risk management is was all about insurance. Okay, so when we'll talk about the history, we will see that in 1700 BC, Babylonians used to do insurance against the marine trades. Okay, so the prime concept of risk management in the initial times was of insurance. So insurance is currently used as a risk management tool under the operation risk, where we actually transfer our risk. There's something that we'll cover some in some other video when we'll talking about the operation risk. But insurance is probably the one of the earliest tools of risk management. And then there this after the World War II, there came this concept of self insurance. So in self insurance, what companies used to do is they used to build a reserve. For example, they used to keep 5% of their profitability in the reserves, and then they used to use that accumulated amount as a tool to cover any losses. This is something that we you can call it like capital adequacy ratio or some reserve funds that companies use to cover the losses. Okay, so insurance and self insurance were the initial topic that initial tools for risk management that we have had back in 1950s and 1960s. So this is it from today's session. In the next session, we will be talking about risk management process, where we'll be discussing how a risk management cycle actually works. If you have any comment, if you have any query regarding this session, please let me know. Thank you.